Hello, my name is Nick Cook and I represent the Property Directors Forum, which has about 150 property directors coming from occupier businesses with premises in the UK, Europe and across the globe. With so many of our members being part owned by private equity, I've come to the offices of Better Capital to gain some insight as to what private equity may be looking for in terms of the role our property directors can make to support their aims and objectives. We're most fortunate to be here with Nick Sanders, who's one of the principal architects, together with John Moulton, of Better Capital. John and Nick have driven exceptional shareholder returns from their portfolio. And Nick has kindly agreed to give our audience an insight into what private equity and venture capitalists are looking for from their investees, and in particular the role the property director can play in supporting their boards. So Nick, welcome.
Thank you.
And perhaps we could start by setting the scene with Better Capital and what it does and how it started.
Well, if you remember back to the end of 2009, the world was in a pretty difficult place. Economically, the wheels had fallen off in the middle of 2008, and three of us got together, myself, John Moulton and Mark Aldridge, to form Better Capital to focus on distressed investing and turnaround opportunities. We've all got a background in that, either buying businesses or turning businesses around in that sector, and we thought, given the economic climate, it was a good place to focus our efforts at that time.
In terms of the private equity scene, can you just articulate the general aims and objectives of the players?
I mean, private equity is just another form of business ownership, and private equity investors, very simple in their objectives. They want to put some money in, they want to see it well deployed in a business, and they want to see a return for that money over a 3 to 5 year period. They're happy usually to put more money in, to build a business, to acquire other businesses, to bolt onto it. But it's just another ownership structure for a business, very different from a public quoted environment where boards and management teams are spending a lot of time talking to their institutional investors. In private equity world, it's much simpler. You've generally got one investor who you're focusing through, and the beauty of private equity is you get a time for the business to be away from the glare of publicly quoted numbers, and for the management to focus pretty much all of its time on running the business.
What kinds of private equity players are there? For instance, I'm specifically thinking of the non-operational partners as well as operational partners.
Yeah, there's quite a broad spectrum. Private equity is a very broad heading, in fact, and you've got people who invest in early stage startups, and they tend to be called venture capitalists, but they're all different forms of private equity. What we call mid-market private equity is where investors will invest in businesses that are not distressed. They'll tend to do a lot of due diligence, have a lot of time to weigh up a business, look at it strategically, its market position, due diligence, its management and their plan, and they are much more financially oriented investors. At our end of the spectrum, where we're working on turnarounds, we have to assume that the business is not just in financial distress, it's in operational trouble as well, and that means that we have to be prepared to get very operationally involved. So there's quite a different focus from the businesses, whereas we're much more operational and hands-on. Some private equity houses are much more handling it like managing it like a part of a portfolio.
And very much horses for courses.
Yeah, absolutely, yeah.
Can you tell us a little bit about what's happening in the world of private equity? As I'm hearing lots of stories in the marketplace about deals being more difficult to achieve, the margins are getting much thinner, and therefore the whole market in general is becoming tighter.
If you look at the activity in the marketplace, it's been really subdued actually since the crash in 2008-2009. If you look at activity levels, M&A activity levels, they were really hit a peak in 06, 07. Prices were very high, but since then they're at a fraction of that former level. Now what The problem for that for private equity businesses means that the few businesses that come onto the market tend to be more expensive. So the danger is you overpay for something. And trade competitors have got a lot of cash at the moment. So big companies have used the last few years to stockpile cash and now in a position to make acquisitions at very attractive prices. But the other problem for a private equity business is if you don't invest the money that your investors have given you, then you have to return it to them. And so actually you're caught between two pretty bad things. Do you pay too much for something or do you return the money you haven't used? And so there's a lot of pressure on private equity actually to get deals done. And that's quite difficult when the market's quite thin.
What does this mean to the average private equity house once they've invested? Are they looking to, or are they needing to, keep a much closer eye on their investees?
Yeah, it's much more difficult for private equity businesses to make returns now. In the good old days, you used to be able to spot an investment opportunity, put some of your own investment money in it, but also borrow a lot of money from banks. And then because markets were generally strong, businesses would grow, you could not do too much actively with your investment, sit on it, watch it grow, repay the debt at the end and make a good return on your money. Those days have gone. It's much harder now to make a return. And the only way I think any private equity business makes money now is to actually invest in a business and make it a better business, not just do a bit of financial engineering. And so the emphasis on private equity guys now to be more operational is really intense, because just sitting on an investment is not going to help now. You've got to prove that, when you bought it, the business was performing at one level. When you sold it, it was providing better products, better services to its customers, and it was worth more. And so it's really hard slog now. There's no easy money to be made in private equity anymore.
What would a CFO and or private equity house be expecting from his property team if he wanted to demonstrate that property was being controlled and actively managed?
Well, there's really two aspects to that. Think first of all about private equity investors going to want to drive the profits and the cash flow, so they're going to want the best possible property deals they can get. So they're going to want to renegotiate on rents, they're going to look for reductions in rateable values, they're going to be looking for monthly rather than quarterly payments and all those things that you might expect. But the other thing, remember, that private equity investors want to do is they want to sell the business after a few years. And with that in their mind, what they'll also be looking for is flexibility. So to get maximum value for a business on an exit, they're going to want to be able to sell it to people who are not bound by very long contracts with no breaks in, because who knows who the new buyer for a business is. They might want to get out of that property and move it into their own offices. They might want to close that factory and move it to Poland. They might want to do all kinds of things. So flexibility in the property portfolio is a real key driver for private equity businesses, not just for while they own it, but to present the business well on an exit.
Clearly data is important. What kind of data sets do you think the average PE house is looking for?
Yeah, we've got 10 businesses in our portfolio, turnover of 1.2 billion, and to a greater or lesser extent, all of them have got different property angles in them. Either they've got old factories we're trying to sell, we've got retailers that have got lots of properties, some they'd rather not have. And so the property agenda is higher up the board agenda with every company that we've got. And I think the more that the property team can demonstrate they're proactively getting on with things rather than being asked to drive change. So looking for the opportunities, pointing out when break points are coming up in clauses, and giving the business team and the board the options to think ahead and saying, well, okay, the lease on X is coming up. Do we want to be there in 2 years' time, or do we want to move out? So that they can start giving the business options, and also obviously managing the contracts very tightly as well, and trying to be quite tough in renegotiating with landlords as well.
Do you see the property director having to become more operationally aware?
Yeah, definitely. Yeah, private equity businesses expect everybody to really be on top of the game. They need to know the data, have the contracts to hand, and so the whole emphasis of, you know, private equity owners want to generate good profits and cash, and they want to prepare the business well for an exit. So getting all of those data, if you bear those things in mind and you act proactively rather than wait to be asked to produce all this stuff, you're going to do far better.
And would you think that the average property director used to only control the leases and the breakpoints and those various other things? The modern property director, who's more operationally aware, is actually looking at tying those back into various other metrics, such as cost per head, revenue per head, revenue per desk, revenue per pallet, and so on. Is that the sort of thing that you would like to see?
Yeah, we when we do due diligence on a business, and bear in mind in the turnaround situation, you're doing due diligence in a small number of days. You know, we have a couple of people who we send out who will go and look at all those different kinds of metrics in the property, because, you know, as part of you evaluating a business, you've got to know what does this property bring to the total investment. And it's very telling, actually, some of the comparators you see even across one business. Some sites look great, some look terrible, some of them look, why are we here, you know? But the general thing about using that data, and from a property director's point of view, saying how can I help drive change in the organisation, because every private equity investor wants that. They want to be able to prove that they can change things and have that flexibility.
In terms of tips that you would give our audience, I'm thinking in particular aspects such as learning the language of private equity, learning to be ultra financially aware, also perhaps focusing on the motives of private equity and the aims and ambitions of the board, and ensuring that property actually connects as much as it can.
Homing in on that point, you need to be talking about cash. You know, that's the lifeblood of what business is about. It's what private equity guys understand. So as property directors, you need to be able to get over to the board in very simple metrics, you know, that we can do this with the property portfolio. Think of ways of concisely putting the situation of the portfolio to the board. These guys have got lots and lots of different things they're trying to deal with. You know, property's big and difficult, and if you're not careful, it gets pushed to the back of the queue. But learn about more than profit, talk about cash. That's the thing that really presses the buttons of private equity guys, because they want cash out of the businesses. And so if you talk about cash returns, change to crash profiles, financing, leveraging, or whatever you can do if it's suitable based on the property portfolio as well, then you'll really get their attention. But put it across in a simple, concise way. Think of, you know, presentationally how you get the story across in a couple of slides without reams and reams of reports, which tends to be what you do get from property directors, I'm afraid.
Property is slow, business is fast. Are there any mechanisms that you'd like to see, or that you're introducing into your portfolio, that you're trying to try and narrow the gap?
What we want to see is maximum flexibility, and to a degree we'll pay for that in terms of cost, and I'm slightly contradicting myself, but actually flexibility is worth a lot. And so rather than enter into a very long-term agreement, looking for shorter agreements with break points in it is a much better way of doing it, I think.
And Nick, what do you anticipate will happen to the private equity market over the forthcoming years? Do you have some form of insight that you could share with us?
The dilemma for private equity is that a lot of funds have got unspent money, and so they've got to, as the market frees up and better assets come to the market, they're going to want to get very active, and I think you'll see quite a big rebound in M&A activity. But I think there's quite a lag with respect to property. If you're a retailer, I think you're going to be sitting with retail properties you don't want for probably 4 or 5 years yet. So I think there's a sort of, it depends on which sector you're in, but there's going to be a washout. It's going to take a while of surplus properties. I think people who have not got big estates, who much more industrial investors, are going to start to see, things are speeding up, the market is getting better, and I would have thought non-retail property is going to get better before the retail space, just because there isn't that huge amount to drag through.
So Nick, as a final thought for our audience, you've referred to mergers and acquisitions, you've talked and you've mentioned due diligence. In your experience, how well prepared are many of the targets for acquisition in terms of their property data?
It really depends. If you're looking at a well-run business in a well-run sale process, then the data room is generally very well populated with data on leases. It'll give you much more about the legal side and the financial side, leaving the buyer to form a commercial view of what they could do with the various properties and how that would fit their own business. I think when you look at our end of the market, in the distressed end, you find actually you have to go and drag the data out. It's there somewhere, but because time is so short, we often find that what we have to do is really go and find, well, why have not one person got all this property data? Why is it in 3 or 4 different people? And it makes it incredibly difficult for us, but we have to do it. We have to find how to pull all that property data together, because these are massive liabilities for businesses if you get it wrong. And in our investing, in due diligence on a business in 5 to 10 working days, you can only focus on the things that are going to kill you quickly. And actually, bad property deals can kill you extremely quickly. Bad delapse agreements, bad lease decisions. And so you have to really be able to get that data. And it's a constant frustration to us how difficult that is to find in many occasions.
Absolutely. And a final closing thought for our audience?
I think the world's changing very quickly. I think you'll have all kinds of pressures on you to change. If you're working in the PE environment, think about cash, think about speed, thinking about getting your story across and being proactive. Don't wait to be asked to do things. Say, here, I can do this, I can help you change the business in this way. And I think that will go down very well.
Nick Sanders, Better Capital, thank you very much indeed. So, in closing, on behalf of the Property Directors Forum, I'd like to say thank you very, very much to Nick and to Better Capital for devoting their time to this particular session. I think what's been really interesting is all the aspirations that I hear, and many of us hear in the property world, about property making a contribution to the bottom line, has been re-echoed by one of the most formidable organisations in terms of dealing with distressed opportunities. So to that extent, I can draw a lot of comfort from the fact that we're on the right lines. It's now really a question of learning what we can do to make that real difference. So on behalf of the Property Directors Forum and myself, thank you very much.